The night over Lake Maracaibo is heavy and still, broken only by the slow creak of oil rigs silhouetted against the dark water. These steel skeletons were once symbols of Venezuelan pride, monuments to a country that sat atop the largest proven oil reserves on Earth. In the night, this lake glowed with opportunity. Dollars flowed. Engineers, traders, and executives flew in from Houston and London. Venezuela was not just rich. It was confident. It was modern. It was certain of its future. Today, many of those rigs stand idle. Rust eats into their joints. The lake smells of crude and decay, and in the distance, Caracas flickers with rolling blackouts, a capital city surviving on rationed electricity and hope. This is not the story of a sudden collapse. It is the story of deals, quiet negotiations, improvised alliances, financial shortcuts, and political bargains that slowly hollowed out an oil economy from the inside. This is the story of Nicolás Maduro's oil economy, and how the deals meant to save Venezuela ultimately accelerated its decline. To understand how a nation blessed with such extraordinary natural wealth could descend into economic ruin, we have to return to the moment when oil stopped being merely a resource and became a political weapon. For most of the 20th century, Venezuela was Latin America's oil success story. After nationalizing its oil industry in 1976, the country created Petróleos de Venezuela, or PD, a state-owned oil company designed to function with technical independence and commercial discipline. For decades, PDVSA was considered one of the most competent national oil companies in the world. Its engineers were respected. Its balance sheet was strong. Its production rose steadily, peaking above 3.4 million barrels per day in the late 1990s. Oil-funded highways, universities, middle-class lifestyles, and a stable currency. Venezuela became a net magnet for immigrants, not emigrants. But beneath the surface, a dangerous dependency was forming. Oil accounted for more than 90% of export revenues and a majority of government income. When oil prices were high, the system looked resilient. When prices fell, the cracks began to show. In 1998, those cracks widened into an opening. Hugo Chávez was elected president on a wave of popular anger. Anger at inequality, corruption, and a political elite that seemed disconnected from everyday Venezuelans. Chávez was charismatic, confrontational, and ideologically committed to reshaping Venezuela's economy. Oil, in his vision, was no longer just a revenue source. It was the engine of a socialist revolution. Chávez moved quickly to reassert political control over PDVSA. Senior executives were purged. Technocrats were replaced by loyalists. The company's profits were redirected toward social programs, subsidized food, healthcare clinics, and direct cash transfers. In the short term, it worked. Poverty fell. Chávez's popularity soared. Oil prices surged through the 2000s, masking the structural damage being done. But PDVSA was no longer being reinvested in maintenance budgets shrank. Exploration slowed. Debt increased. The company was quietly transformed from an oil producer into a government ATM. When Chávez died in 2013, his chosen successor, Nicolás Maduro, inherited an oil economy already weakened, and a political system built entirely around oil-funded loyalty. Maduro was not Chávez. Where Chávez was a commanding presence, Maduro was cautious, reactive, and deeply dependent on the inner machinery of power, the military, the ruling party, and a shrinking circle of trusted insiders. And almost immediately, the external environment turned hostile. Oil prices collapsed in 2014. From over $100 a barrel, prices fell below $40. For Venezuela, this was an economic earthquake. Dollar inflows evaporated. Imports dried up. Inflation surged. The bolivar, already distorted by years of currency controls, began its descent into worthlessness. At this moment, Maduro faced a choice. Restructure the economy, reduce dependence on oil, restore PDVSA's technical independence, and accept political pain, or find new deals to keep the oil money flowing at any cost. He chose the deals. One by one, Venezuela turned to unconventional arrangements to survive. Oil was no longer just sold on open markets. It was pledged, swapped, prepaid, and quietly discounted in back rooms far from Caracas. China was one of the first lifelines, beginning under Chavez and accelerating under Maduro. Venezuela entered into massive oil forloans agreements with Beijing. Chinese state banks provided tens of billions of dollars in financing to be repaid not in cash, but in oil shipments. On paper, it looked like a partnership between two rising powers. In reality, it locked Venezuela into years of future oil deliveries at fixed terms, reducing flexibility just as production began to fall. Then there was Russia. Rosneft stepped in with loans backed by stakes in Venezuelan oil projects and even collateral in PDVSA's U.S. refining arm, Citgo. These deals provided short-term cash and long-term leverage. Venezuela was selling pieces of its energy future to stay afloat in the present. As Western sanctions tightened, another shadow economy emerged, traders operating through intermediaries in Asia, the Middle East, and the Caribbean began moving Venezuelan crude under opaque contracts. Oil was sold at steep discounts. Ship transponders were turned off. Cargoes were renamed. Payments were routed through complex webs of shell companies. Each deal kept the system alive a little longer. Each deal also stripped away value, transparency, and control. Inside PDVSA, chaos reigned. Experienced engineers fled the country, unpaid or politically sidelined. Refineries malfunctioned. Pipelines leaked. Production collapsed from over 2.5 million barrels per day in 2013 to under 1 million by the end of the decade. And yet, even as the oil economy imploded, the deals continued. Because these deals were not just about economics, they were about power. Oil shipments were used to secure loyalty within the military. Fuel was subsidized to near zero, prices at home, even as shortages spread. Gold from Venezuela's reserves was swapped for foreign currency. Cryptocurrencies were introduced in a desperate attempt to bypass sanctions. Each maneuver bought time, but at a growing cost to institutional credibility. By the late 2010s, Venezuela's oil economy had become a labyrinth of improvised finance, a system designed not to maximize production or efficiency, but to keep a fragile political structure standing amid international isolation. For ordinary Venezuelans, the consequences were devastating. Supermarket shelves emptied. Hospitals lacked basic supplies. Millions fled the country, forming one of the largest migration crises in modern history. Oil, once the backbone of national prosperity, had become a distant abstraction, flowing out through secretive channels while daily life collapsed. The tragedy of Maduro's oil economy is not that Venezuela ran out of oil. It is that oil ran out of ways to save Venezuela. And as the rigs over Lake Maracaibo continue to rust under the tropical sun, the deals that once promised survival now stand as evidence of how a resource-rich nation can be financially engineered into collapse one transaction at a time. By the time Venezuela's oil economy reached this stage, the collapse was no longer loud. It was procedural. It happened in contracts written in legal language few Venezuelans would ever read, in shipping manifests quietly altered at sea, and in balance sheets that no longer balanced at all. To see how deeply these deals reshaped the country, we have to step inside the machinery of PDVSA itself, into the offices, refineries, and trading desks where Venezuela's oil stopped behaving like a commodity and began behaving like collateral. In Caracas, PDVSA's headquarters, once buzzed with engineers debating extraction techniques and executives planning decades ahead. By the mid-2010s, the atmosphere had changed. Many floors were half empty. Elevators stalled from lack of maintenance. Technical meetings were replaced by political briefings. Loyalty mattered more than competence. The company's financial structure had quietly deteriorated years earlier. PDVSA had taken on increasing amounts of debt to fund government spending, issuing bonds that investors once viewed as risky but manageable. As oil prices fell and production declined, that debt became suffocating. Servicing it required dollars, and dollars were disappearing. Currency controls made the problem worse. Venezuela operated multiple official exchange rates, all wildly overvalued compared to the black market. For insiders with access to cheap official dollars, This created massive arbitrage opportunities. For PDVSA, it meant selling oil abroad for dollars, then being forced to convert much of that revenue into bolivars at artificial rates, destroying real value. By 2016, PDVSA was effectively insolvent. But insolvency did not mean collapse. It meant improvisation. One of the most consequential improvisations was the expansion of oil for debt arrangements. China's loans were no longer fresh capital injections. They were refinancing exercises designed to avoid outright default. Venezuela shipped hundreds of thousands of barrels per day to China, often at prices far below market value once transport costs and repayment terms were factored in. These barrels generated no discretionary cash. They simply serviced old obligations. In economic terms, Venezuela was producing oil that didn't belong to Italiano. Russia's involvement followed a similar logic. Rosneft provided bridge financing in exchange for future oil deliveries and stakes in joint ventures. The most controversial collateral was Citgo, PDVSA's crown jewel in the United States. Citgo owned refineries strategically designed to process Venezuela's heavy crude and generated steady dollar income. By pledging Citgo shares as collateral, PDVSA was effectively mortgaging its last reliable source of cash. These were not long-term development partnerships. They were emergency loans taken at the worst possible moment, when Venezuela's bargaining power was weak. At the same time, U.S. and European sanctions closed off traditional markets and financing channels. Officially, sanctions targeted government officials and restricted new debt issuance. Unofficially, they poisoned the entire ecosystem. Banks refused to clear payments. Insurers backed away from shipping Venezuelan crude. Reputable trading houses exited. What filled the vacuum was a paralleled oil market. Small trading firms, some newly created, others operating from jurisdictions with weak oversight, began moving Venezuelan oil through layers of intermediaries. Crude was blended, relabeled, and resold. Payments arrived late, partially or not at all. Discounts grew steeper. Every transaction became riskier than the last. This shadow system benefited a narrow group of insiders. Control over export contracts became immensely valuable. So did control over fuel imports. Ironic, in a country sitting atop vast oil reserves, Venezuela began importing gasoline, often at inflated prices, while its own refineries sat broken. The paradox was painful. The oil economy was still functioning, but it was no longer serving the country. Inside Venezuela, the social contract unraveled. Fuel shortages stretched for days, then weeks. Electricity blackouts rolled across entire states. Water pumps failed. Inflation exploded into hyperinflation, erasing salaries faster than they could be paid. The bolivars ceased to function as money, replaced by dollars, barter, and digital payments. And yet, the oil deals continued to shape daily life. Subsidized gasoline, once a symbol of national abundance, became a tool of control. In some regions, access to fuel depended on political loyalty or military connections. Trucks carrying food or medical supplies stalled for lack of diesel. Oil, the lifeblood of the economy, became a choke point. Maduro's government framed these struggles as the result of economic warfare. Sanctions were blamed for everything from food shortages to refinery accidents. And sanctions did matter, but they interacted with years of mismanagement and underinvestment in ways that magnified their impact. By the late 2010s, Venezuela's oil infrastructure was dangerously degraded. Pipelines leaked into rivers and farmland. Refinery explosions killed workers and shut down production. The Orinoco Belt, one of the largest heavy crude deposits on Earth, sat underdeveloped, its potential trapped by lack of capital and expertise. The tragedy was not simply economic. It was institutional. Oil economies rely on long-time horizons. Wells drilled today pay off years later. Refineries require constant maintenance. Markets reward predictability. Venezuela's system, by contrast, was built around survival from one month to the next. Every deal was reactive. Every agreement traded future capacity for present cash. Even attempts at reform were constrained by this logic. In 2020 and 2021, as global oil markets reeled from the pandemic, Venezuela's production hit historic lows, under 400,000 barrels per day. Some sanctions were quietly relaxed. Foreign companies were allowed limited operational control. Joint ventures were restructured, but rebuilding an oil industry is not like flipping a switch. Skilled workers had left. Equipment was cannibalized. Trust was gone. Investors remembered defaults, expropriations, and opaque contracts. Even if oil prices recovered, Venezuela lacked the institutional scaffolding to capitalize on them. What remained was an economy trapped in extractive stasis, still pumping oil, still exporting crude, but generating far less value than its resource base should allow. And beneath it all was a deeper question, one that haunted every deal signed during Maduro's presidency. Was the goal to save the oil industry, or was it simply to keep the regime alive? Because when oil becomes a political instrument rather than an economic one, efficiency stops mattering, transparency becomes dangerous, and decline, once it begins, becomes self-reinforcing. The rigs over Lake Maracaibo did not rust because oil disappeared. They rusted because the system that sustained them no longer existed. To understand why Venezuela's oil economy could not recover, even when global conditions briefly improved, we have to examine the incentives that governed decision-making at the very top. Because what looks, from the outside, like incompetence or ideological rigidity often looks very different from inside a system built on survival. For Nicolás Maduro and the coalition that kept him in power, oil was not a growth engine. It was a stabilizer, a way to keep key factions aligned, to reward loyalty, and to neutralize threats. The logic of the deals makes sense only when viewed through that lens. The military was central. Over the years, senior officers were placed in charge of ports, refineries, food distribution networks, and even PDVSAs. Control over oil logistics meant control over cash flows, imports, and patronage. In a collapsing economy, these positions were immensely valuable. Reforming PDVSA in a way that restored technocratic independence would have meant loosening that grip. That was a risk the regime could not afford. So instead of rebuilding institutions, the government doubled down on discretionary control. Contracts became more opaque. Oversight weakened. The line between state assets and personal networks blurred further. Oil exports were no longer about maximizing national revenue. They were about allocating scarcity. This dynamic distorted every economic signal. In a functioning oil market, production responds to price, cost, and demand. In Venezuela, production responded to political pressure and operational improvisation. Wells were reopened without proper maintenance. Heavy crude was blended incorrectly. Equipment failures multiplied. Each technical shortcut increased long-term damage. At the same time, the international environment hardened. U.S. sanctions expanded in 2019, directly targeting PDVSA's ability to sell oil and repatriate proceeds. The intent was clear: starve the government of revenue. The effect was more complex. Formal exports collapsed, but informal channels adapted. Middlemen extracted higher margins. Discounts widened further. Transparency vanished almost completely. In economic terms, Venezuela moved from a regulated oil economy into something closer to a sanctioned barter system. Oil was exchanged not just for money, but for food shipments, fuel swaps, political recognition, and diplomatic protection. Turkey processed Venezuelan gold when traditional channels closed. Each arrangement bypassed sanctions and embedded Venezuela deeper into a fragmented, high-friction trading network. The cost of doing business skyrocketed. This mattered because oil is a scale business. Profitability depends on volume, efficiency, and predictability. Venezuela had lost all three. Even when oil prices rebounded in 2021 and 2022, the country captured only a fraction of the upside. Much of the value was absorbed by intermediaries or lost to inefficiency. Meanwhile, Venezuelan society adapted in ways that permanently altered the economic landscape. Dollarization spread organically. Informal markets flourished. Remittances from abroad became a critical lifeline. A new survival economy emerged, flexible, unequal, and disconnected from the state's oil revenues. For many Venezuelans, oil stopped being relevant to daily life altogether. This was a profound shift. For decades, oil had been the invisible hand shaping everything, from public employment to consumer imports. Now, it existed in parallel to everyday reality. The state still depended on it. The population increasingly did not. That divergence made recovery even harder, because rebuilding an oil economy requires public trust. It requires confidence that contracts will be honored, revenues and institutions protected from political capture. Venezuela's recent history offered little reassurance on any of those fronts. Foreign investors remembered expropriations under Chavez. Bondholders remembered defaults. Trading houses remembered unpaid invoices. Engineers remembered arrests. Trust, once broken, does not return quickly. And yet, within the regime, the deals continued to make sense. They bought time, they kept fuel flowing to critical constituencies, they preserved access to foreign currency, they prevented sudden collapse. In a political system where losing power could mean exile or prison, short-term survival outweighed long-term development. This is the central tragedy of Maduro's oil economy. It functioned just well enough to prevent reform, but too poorly to sustain prosperity. By the early 2020s, Venezuela's oil production stabilized at a low level. Some infrastructure was patched. Limited foreign participation returned under strict conditions. The headlines spoke cautiously of recovery, but beneath the surface, the same structural constraints remained. PDVSA was still heavily indebted. Its workforce was still depleted. Its governance was still politicized. And the deals that defined its operations were still shaped by necessity, not strategy. Oil was no longer a ladder out of crisis. It was a ceiling. In the end, Venezuela's decline was not inevitable. Other oil-dependent countries weathered price shocks, mismanagement, and political turbulence. What made Venezuela different was the accumulation of choices, each rational in isolation, each damaging in combination. Every discounted shipment, every mortgaged asset, every opaque contract. Together, they transformed the world's largest oil reserves into a diminishing source of leverage and a shrinking promise of recovery. In the next chapter of this story, we confront the long shadow of those deals, what they mean for Venezuela's future, for global energy markets, and for the enduring lesson of how resource wealth can become a trap rather than a foundation. The shadow of Venezuela's oil economy now stretches far beyond its borders. What happened inside PDVSA did not stay inside PDV. It rippled through global energy markets, international finance, and the political calculus of countries watching closely, some out of concern, others out of opportunity. To understand the final consequences of Maduro's oil deals, we need to widen the lens. On the global stage, Venezuela's collapse reshaped supply dynamics in subtle but meaningful ways. For years, Venezuelan heavy crude had been a cornerstone input for refineries along the U.S. Gulf Coast. These facilities were designed specifically to process dense, sulfur-heavy oil, exactly the kind Venezuela produced in abundance. As shipments dried up, refiners turned to alternatives from Canada, Mexico, and the Middle East. Supply chains adjusted, capital shifted. By the time limited Venezuelan exports began returning, much of the market had already moved on. This mattered because oil markets have memory. Once refiners invest in alternative supply chains, they are slow to reverse course. Venezuela's absence became normalized. Its bargaining power diminished further. Even when sanctions were partially eased, Venezuela was no longer indispensable. Meanwhile, within OPEC, Venezuela's voice faded. Once a founding member and influential producer, it became a marginal participant, unable to meet quotas or shape policy. Decisions were increasingly driven by Saudi Arabia, Russia, and a handful of other producers with operational flexibility and financial buffers. The contrast was stark. Where other oil states used boom years to build sovereign wealth funds, diversify their economies, and maintain spare capacity, Venezuela had used its windfalls to fund consumption and political loyalty. When the bust came, there was nothing left to absorb the shock. International lenders took note. Venezuela's default on its sovereign and PDVSA bonds became a case study in how political risk can overwhelm resource wealth. Creditors spent years entangled in legal battles over assets like while ordinary Venezuelans bore the economic cost. Future borrowers, especially state-owned oil companies, faced higher risk premiums as investors recalibrated their assumptions. The deals that kept Maduro's government afloat thus imposed a long-term tax on Venezuela's financial credibility. Inside the country, the social consequences hardened into a new reality. Entire generations grew up without stable electricity, reliably, fuel, or predictable income. Professionals emigrated en masse. Universities hollowed out. The oil sector, once a source of national pride and technical excellence, became something young Venezuelans associated with danger, politics, and decay. This loss of human capital may be the most enduring damage of all. Oil reserves do not extract themselves. They require geologists, engineers, financiers, and managers. Rebuilding that ecosystem could take decades, even under ideal political conditions, and those conditions remain uncertain. Maduro's survival strategy worked in the narrowest sense. The regime endured, but endurance came at the cost of economic stagnation and institutional erosion. Venezuela today produces far less oil than its geology allows, earns far less from what it produces, and captures far less benefit for its population. The deals that accelerated this decline were not dramatic betrayals or singular mistakes. They were incremental compromises, each one framed as temporary, necessary, unavoidable. This is how resource traps form, not through sudden catastrophe, but through the slow substitution of strategy with survival. The lesson of Maduro's oil economy is not confined to Venezuela. It echoes across other resource-dependent states facing political pressure, fiscal stress, and external constraints. When institutions weaken, when transparency erodes, and when long-term incentives collapse, natural wealth becomes a liability rather than a shield. Oil magnifies whatever system governs it. In Venezuela's case, it magnified fragility. The rigs over Lake Maracaibo still stand. Beneath them, the oil remains. But the system that once transformed that oil into shared prosperity has been dismantled piece by piece, not by a single villain, but by a cascade of deals made under pressure, in the dark, with diminishing options. Reversing that process will require more than higher oil prices or looser sanctions. It will require rebuilding trust, restoring institutions, and redefining the role oil plays in the nation's future. Until then, Venezuela's oil economy remains a cautionary tale, not of scarcity, but of squandered abundance. Thanks for watching this episode of Inside Maduro's Oil Economy, the deals that accelerated Venezuela's decline on Economy Elite. If you like this video, just watch another one on the Economy Elite channel.